The market has no interest in our opinions or what we think should happen. It only cares about what it is actually doing, and it records that reality through price action and the structure it creates. When we remove the layers of noise from a chart, the indicators and complex theories, we are left with the purest language available to us, raw price. Every movement and rejection is written right here. This chart shows the architecture of a move, known as market structure. In an uptrend, the market builds itself through a sequence of higher highs and higher lows. It moves in waves, advancing and then pulling back without breaking its previous support. As long as each pullback holds above the previous low, the structure indicates that the underlying trend is healthy. These pivot points are the landmarks that tell us the character of the market hasn't changed. Structure shows us where the market is going, but candlesticks tell us how decisively buyers or sellers are winning the battle at key levels. At this higher low, price touches the level and retracts immediately, leaving a long lower wick. This rejection shows an aggressive surge of buying. To confirm conviction, we look at the volume bars below, representing the participation behind the move. Note the difference between these two scenarios. On the left, price reaches a new high on low volume, suggesting exhaustion. On the right, price breaks a level on high volume, indicating strong participation and follow-through. A valid structural shift requires a decisive close in price and a corresponding increase in volume. These two factors together confirm the market's intention. Markets move in different degrees of trend simultaneously. This often causes confusion when a long-term uptrend contains a short-term period of falling prices. In this split screen, the weekly chart on the left is in a structural uptrend, while the daily chart on the right is making lower lows. To manage this, we wait for alignment rather than fighting either timeframe. The opportunity arrives when the daily chart forms its first higher low, turning back into alignment with the weekly trend. This is the point where the odds favor a continuation of the larger move. Consider this scenario. During the day, price pierces through support on high volume, but by the end of the period, it has recovered to close back above the line. The market structure is not broken here. The close shows that while sellers tried to push price lower, the buyers successfully defended the level before the battle ended for the day. Having a system is only half the battle. The other half is the discipline to sit with a position and let the market work, even when it pulls back. As price pulls back, fear tempts early exits. But if price holds above the previous low, structure is intact, in. However, if the market violently breaks that low, character changes. When structure breaks, exit immediately. Do not second guess. To trade this method, follow these 4 steps. Identify the structure of higher highs. Wait for timeframes to align, confirm with price and volume, and use structure for exit rules. The market will pay those who can read what it is actually showing them. By focusing on the objective language of structure and price, you stop trading your opinions and start trading the reality of the move.